Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey.
In the last episode, we followed a trade through clearing and settlement. This time around, we're going to look at something much stranger: selling shares you don't own. A short sale begins with borrowing something that eventually must be returned. And to understand why short selling works the way it does, we're going to look at it through the lens of two books written from very different perspectives. Catherine Staley's The Art of Short Selling reads like a field guide for financial detectives. And Sebastian Malaby's More Money Than God reads like a history of the hedge fund industry and the strange strategies that grew inside of it. Together, they tell a surprisingly coherent story. It begins with something Staley emphasizes almost immediately. Unpopular companies aren't a primary target for short sellers. They're looking for companies where the story is improving faster than the underlying business. Markets love stories. Growth narratives, visionary leadership, exciting industries, these things travel quickly and stock prices can move long before the details of the business fully catches up, and short sellers spend their time in those details. Staley describes how short sellers tend to notice quiet inconsistencies and patterns most investors ignore. Things like revenue rising quickly while cash flow barely moves, receivables growing faster than sales, inventory is accumulating while management keeps talking about strong demand. Separately, these things aren't scandals. Businesses can experience temporary distortions for many reasons, but Staley notes that when several of these signals appear together, they begin to form a pattern. Weak companies tend to leave fingerprints in their accounting. Short sellers spend an enormous amount of time reading financial statements because those fingerprints often appear long before the market reacts. If you want an example, go to Michael Burry's Substack. But one of the more surprising insights from Staley's book is how often short sellers uncover problems simply by reading carefully. That sounds underwhelming, but that's how many famous short cases started. Someone just noticed that the math wasn't mathing, and the rest of the story can unravel from there. But here's what Staley emphasizes is unusually difficult about short selling. Being right about a company's weakness doesn't mean the market will quickly agree. Markets can maintain optimistic narratives for extremely long periods of time. Investors want growth stories to be true, and management teams aren't usually eager to highlight their own weaknesses. That's why many short sellers are early, not wrong. This is where Malaby's perspective becomes useful. More Money Than God explains how hedge funds adapted short selling to something broader than simply betting against companies. Instead of trying to predict the direction of the entire market, hedge fund managers focus on the relative differences between businesses. If they believe one company has strong margins, disciplined management, and steady cash flow, they might buy that company while shorting a competitor that appears to be growing quickly but relies on aggressive accounting or constant financing. If that analysis is successful, the stronger business will outperform the weaker one over time. With this setup, the overall direction of the market matters less. If the entire sector rises, the stronger company may still rise more. If the sector falls, the weaker company may fall faster. Malaby describes how this approach gradually reshaped hedge fund investing. But Malaby also spends a considerable amount of time describing the infrastructure that makes this possible. Short selling doesn't happen in isolation. It depends on a network of institutions working quietly behind the scenes. Prime brokers arrange the borrowing of shares from pension funds and other large investors. Those investors lend their shares through securities lending programs, earning small fees while maintaining their economic ownership. Borrowers post collateral and pay borrow rates that fluctuate with supply and demand. What looks like a simple trade on a screen is actually the visible edge of a much larger lending system. Without that system, professional short selling would be extremely limited. One of the more surprising lessons from The Art of Short Selling is how often fragile companies depend on constant access to new capital. Companies can appear profitable on the surface while quietly relying on new financing like issuing stock, raising debt, or acquiring other companies, all to keep the story alive. As long as the capital keeps flowing, the narrative can continue. But when that funding slows, the underlying weakness suddenly becomes visible. So again, it's all about understanding where the market's judgment is drifting furthest from reality. And that brings our story back to the beginning. A short sale starts with borrowing shares that have to eventually be returned. That obligation quietly shapes the behavior surrounding short selling. Borrowed shares move through a lending system that most investors never see. And of course, borrowing shares isn't the only way investors can create short exposure. Option swaps and other derivatives can replicate the economic effect of short selling without directly borrowing the stock. Those structures add layers to the system, but they still trace back to the same basic basic logic. Someone is positioned to benefit if a price falls, and eventually, somewhere in the system, someone has to buy shares to close the position. The right question then becomes, when? Like, subscribe, follow @TheMagnificent on Instagram and X, and let's keep the education going every Sunday at 11 a.m. Central.